Escape the tax trap. In this episode, I'm going to explain why deferring tax in IRAs and 401ks is not smart. Hopefully, this will help you prevent getting yourself in a tax trap. So I'm Doug Andrew. I've been a financial strategist, a tax minimization specialist, retirement planning specialist for more than 48 years, helping people optimize assets and minimizing taxes so they will not outlive their money. And so this is huge. A lot of times people just think, well, I'll deal with my tax bracket when I retire. And oftentimes, as I explain in my various books and educational videos on this very channel, that people get trapped and they go, oh my heavens, why didn't somebody prevent this? Now I'm going to have to be cured from this tax dis-ease. Now, when you're not at ease physically, okay, we call that disease. When people are not at ease financially because they're getting clobbered with taxes at the time in life that they thought they were going to be in a lower tax bracket. And if they were savers, they're sort of shocked. They're not in a lower tax bracket. They're in as higher tax bracket as they've ever been. And so this is where a lot of people come to this rude awakening and they go, how did this happen? Every advisor told me to put money into tax-deferred IRAs and 401ks. Hence, about 91% of Americans, I think, are duped into putting money into tax-deferred IRAs or 401ks, being told, and also 457s, 403bs, pensions, profit-sharing plans. They're all qualified plans, but they're qualified with who? Yeah, Uncle Sam, the government. They always have these strings attached. You can only put in a certain dollar amount or a certain percent of your income. If you touch any of the money before you're age 59 and a half, there's a 10% penalty. If you do not start withdrawing money by the age of 72, at least required minimum distributions, there's another penalty. That one is 50%. Yeah. If you're supposed to pull out 50 grand and you don't, the penalty is 25,000 on top of the tax on the 50,000. See, the government wants that money out in tax before you die so they can tax it again when you do die. So a lot of times people don't realize that. They just think, well, I'll deal with it when I get there. Well, when they get there, they're shocked because they were going down the highway, so to speak, with one foot on the gas pedal and the other foot on the brake pedal, so to speak. They were putting money into these tax-deferred accounts like IRAs or 401ks. That's the foot on the gas. But the other foot was on the brake, meaning they were sort of killing their tax deductions as they were going. Most of us, we want to get out of debt and pay off our house. So you don't have that deduction anymore. When you're retired, you're not contributing money to IRAs or 401ks, and so you don't have that deduction anymore. Your children are usually gone, or if they move back as adult children, you cannot deduct them anymore. If you're a business owner, you don't have those deductions anymore. So you have this other foot on the brake, and then when you hit retirement, you don't have all these deductions anymore, and now you withdraw money. And even if your income is less than what you were earning the last few years that you were working, people pay as much or more in taxes. They are in the same bracket or higher than when they were working, even if they have less income. If they save very much, they're going to have to pay tax on a larger income because of the required minimum distributions. But then they get duped into taking the minimum, thinking they're saving tax by continuing to defer. I'll come back to that point. And so they go through retirement and they are paying tax the rest of their life. And they're going, whose retirement was I planning anyway? And so it's like this illustration that I often use in my educational events. So many times people would come to me at retirement. Now, at retirement planning is something totally different than maybe what you did for your retirement planning. And a lot of people think, well, don't I just now start taking money out of my IRAs or 401ks invested in the market. And this is where I find a lot of Americans are way too top heavy in those accounts and yet to be taxed IRAs and 401ks invested in the market. And Wall Street was not built to create predictable income. That's why I always go, what are you thinking here? You're not in a lower bracket, you're a saver. And so now we have to sort of cure that tax dis-ease. We have to get the taxes over and done with sooner than later. And sometimes people go, oh, I don't want to pay tax. Let's just keep deferring. Well, defer means to put off or procrastinate. When has procrastinating anything turned out good for you? It hasn't for me. And so it's a little bit painful sometimes when I illustrate a strategic rollout. That's not a rollover, it's a rollout. A rollover is going from the frying pan into the fire, so to speak. That's taking money in IRAs. And actually, most of the time, people have money in 401ks and they roll it over to an IRA because they left the company's employ. And then they defer until they're age 72. And then they have to start taking out the required minimum distribution based on their life expectancy. And that may be, let's see, at age 72, if your life expectancy is 20 years, let's say, which is pretty close to what it is for a healthy 72-year-old, you have to take out 1/20th or 5%. So if you have $1 million nest egg, you have to pull out 50 grand. If you don't, the penalty is 25,000. But people get duped into taking out the minimum thinking they're saving tax. And years ago, I developed a software system that showed people the darkness of the night, so to speak, if they kept deferring. And then if they took required minimum distributions, which I think is the worst advice for most retirees, but it's the most common advice because accountants think they're saving tax in that given year, and that's the smartest advice. No, look at the big picture. And people are shocked when they see how much they pay in tax by stringing it out over their life expectancy, their spouse's life expectancy, and then you die and leave it behind to your children. Now, most savvy CPAs and tax attorneys will agree, the worst place to leave your money when you both pass away is in a tax-deferred IRA or 401k, and leave it to your children because they cannot keep it until they retire. They must take that money out and pay the tax on it within 10 years. See, the government's been counting on that tax revenue. So this is what their after-tax IRAs and 401k sort of look like. They come and they go, oh, look at this $1 million I've accumulated in these IRAs and 401ks, like it's this sumptuous Subway hoagie sandwich depicted here on the left. But then I show them what it looks like after tax. And it's interesting because many times I'll sort of tease them and say, well, when you come to your first appointment, this is at retirement planning, maybe 5 years before they retire, bring your after-tax IRA and 401k statements with you. Now, I know they don't have them, but they go, after-tax statements? Yeah, no, if you don't have those, I'll calculate them for you. And basically, if they come with $1 million nest egg, I'll say, well, about 650,000 of that is your money. The rest belongs to the government. Okay. If $1 million was generating, let's say 10%, 100,000, you pull out 100,000, you're only netting 65,000 after federal and state tax. 41 out of 50 states has a state income tax. If it's generating 7.5%, you pull out 75,000 out of $1 million. And 25,000 goes out in tax, and you're netting 50,000 bucks to buy gas and groceries. That's what I mean. It looks like this unappetizing sandwich on the right after the government has helped themselves to several bites. So when people would do this, oftentimes they would come to me thinking that they would somehow deal with their money in those IRAs or 401ks invested in the market. And then they realized the market volatility, the actual return for retirees on people who have it in the stock market is only 3.49%, according to Dalbar. If you bought and held, maybe 9%, and you might net 6 after tax. So $1 million nest egg could generate 90,000 a year, and you'd net 60,000 after tax. But Dalbar says, no, most retirees who have money in IRAs and 401ks in the market only average a little less than 3.5%, because when the market goes down, people get panicked and they see their retirement nest egg dwindle down by 30%, 35%. And they say enough already. And then they sell low. Okay. And then they wait till the market comes back, and they get confident again, and then they buy high. So the average return is 3.5%. And that's what precipitated the 4% rule in the financial services industry. Because people only average 3.5%, they only want you to pull out 4. Because if you're only earning 3.5 and you pull out 4, you're going to slowly deplete that nest egg, but hopefully not before your LE, your life expectancy. So you earn 3.5 and you pull out 4, you're going to slowly deplete it. That is called the 4% rule. My goal for my students and in all of my books is for you to sort of, I'm a skier, to be able to, on the last run, instead of taking unnecessary risk and crashing and burning on the way down the mountain, because we are retiring, we're going down the mountain. And is to be able to maybe just ride in the gondola and be nice and warm and land safely in retirement, instead of so many people who realize, oh, I might outlive my money. I didn't realize taxes were going to be this high. Inflation is going to kill me. And so they go out and they take unnecessary risks on their last trip down the mountain in retirement, and then they lose even more money. And so I want you to coast down in safety. But when people would come to me with their yet to be taxed IRAs and 401ks, I would say, man, were you planning your retirement or Uncle Sam's? Because Uncle Sam is going to get a piece of this the rest of your lives if you follow your accountant's advice and keep deferring or postponing, procrastinating until you're 72, and then take out RMDs. And when they would see this, they would go, oh my heck. I showed this to two school teachers, a husband and wife. They had $250,000 in their 403Bs and their TSAs when they came, and they were shocked when I showed them that $250,000. That would end up continuing to grow, hopefully, at maybe 7.2%, double to 500,000 by the time they were 70 and a half back then, and then generate income. And I showed them at a minimum, if tax rates never went up, they were going to pay $250,000 in unnecessary tax. And I said, you know what, let's just get it over and done with. So from age 59 and a half to age 64 and a half, we pulled out $60,000 a year. They had to pay tax of about $12,500, but we ended up over 5 years paying only about $60,000 in tax instead of $250,000. And we repositioned the net after tax money into the laser fund, a portfolio of laser funds. I'll help you understand what that is in just a moment. And they had double the income, but it was painful for 5 years. But then they absolutely loved what happened after that 5 years because they had double the income and it was totally tax-free. We've done this for thousands of people. We've saved, people 750,000, 1.2 million. We've taken people from the highest tax bracket in California to a 0% tax bracket in 5 years. And so the key is what you do at retirement. And so you want to choose the strategies and the vehicles that will generate the most income at the time in life you're going to be needing the money the most. And people get this rude awakening. I am not in a lower bracket. I've been saving money. Inflation is going to erode away a lot of my purchasing power. So we help them become immune from taxes, inflation, and market volatility. But deferring tax in IRAs and 401ks is not smart. I've never owned an IRA or 401k. I never will. And I've never owned a Roth IRA or 401k, even though it's a step in the right direction. If you think taxes in the future are going to be higher, which I do, and most people do. Roths only have two benefits. You contribute with after-tax dollars, you accumulate your money tax-free, and you can access it tax-free. My favorite vehicle, called the Laser Fund, does that and has 4 additional benefits Roths will never have. So you can learn more about this incredible instrument. It's called the Laser Fund and what it is and how it works. But this is where people can accumulate their money tax-free. They can access the money tax-free. When they die, it blossoms and transfers tax-free. It's been a sacred tax-free cash cow in the Internal Revenue Code for now over 108 years. I would recommend that 40 to 60% of your retirement income not even show up on the front page of your 1040 tax return. The IRS will know you're receiving it, but they'll know it's tax-free. You can learn more about this in the book, and that there's only 3 types of income that we pay income tax on in America since 1986: earned income, passive income, and portfolio income. Money out of a laser fund is not deemed any one of those 3. It is cut and dried tax-free. So to claim your free copy, I'll gift you the book. Simply go to laserfund.com, LASER fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I will pay for the book. You don't have to pay $20 on Amazon for it. Now, it's 300 pages, but it's actually 2 books. This white covered side is about 200 pages, 14 chapters with all the charts and graphs if you're a left brain learner. If you're more of a right brain learner, you flip the book over to this one, 100 pages, 12 chapters with 62 actual client stories. If you want to learn both right brain and left brain, I would recommend you read both books. But this is your key to a brighter future. When you're claiming your free copy, there's also options there if you like to listen and learn or watch and learn. You can check out some of the online webinars that we do. And also you can engage and actually talk to a professional who knows how to structure one of these correctly and fund it properly. And you can pick their brain, and they will not charge you for their time. So take advantage of all of these resources. Subscribe to this channel. I post an in-depth answer to a financial question almost on a daily basis. But this is about you and your brighter future.